All right, after what was an outstanding day yesterday, really had a lot of momentum and opportunity to really push us up and continue this trend, an opportunity to build on something. Today we didn't quite build on it. In fact, we had a really small range today, really small move. Not a lot going on. Pullbacks in some of these stocks that did so well yesterday. So it had its inevitable impact on the markets. And so the market forecast is kind of at this point right now where the next 2 days can really dictate whether we are at the end of this trend that we're on right now or whether we can maintain it for however much longer. And that's kind of like that's what I'm going to describe today in today's video, kind of what we need to see, what I expect to see, but what we need to see to keep it going, and then why that it could lead to more weakness, at least could be signaling more weakness to come in the markets here. And there's other indicators too that are kind of leaning in that direction. In the weakness direction. We're going to point that out. Again, nothing necessarily that is saying, hey, we're going to fall 20% here. No, nothing like that, right? But in terms of like this 20% rally we've been on, it's a freight train that has no end in sight. It appears there is an end in sight now. Again, that doesn't mean that we have to be bearish. It just means that this run might be close to being done. We'll talk about why. The rotation that's going on that also kind of signals that. And then our trade idea as a stock, again, we've been looking at some bullish signals, different things breaking out in different areas. And there's, again, another area outside of that cyclical area, the XLK, XLY, XLC, of a stock that broke out to the upside and really breaking out above multiple resistance levels. So we'll talk about how to trade that in light of this context of the broader market expectations. So let's go ahead and get started. Today is Wednesday, March the 13th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hi, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook Live video, where I review all the old trades we've done, see whether we should stay in them or not. We also put on today's trade already before the market closed there. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click this thumbs up icon. It opens up that tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So thank you to those who do this day in and day out. It's a really big deal for us. Our goal is to get to 100. So thank you again. Those who don't, you can do right now while you're watching with 1 or 2 really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you see, we finished down just a little bit today, only 0.2%. Very small range, ended up at 27 points, so just a little bit above half the average. The average at 47. And remember, that average is pretty small to begin with, so to be less than that's really significant. And it was half of that. It wasn't down enough to keep the near-term line from getting up above the 80th percentile, so it did get up to the 84th percentile. That's a pretty good level above. It's not the highest. It's definitely not in the 90th yet, but see this one you got up above, you got to the 88th. So it's, you could say, oh, we got into, we might be able to avoid a bearish near-term peak. If we were to drop back, say, out of bearish territory tomorrow, or bullish territory tomorrow, if we were to drop back below 60, for example, then that would be a bearish peak. That's just kind of a toe dip above there. If we were to get up above 90 tomorrow, which is more likely, that's the more likely scenario, then that would actually be really good. Then now we don't have to worry about multiple bearish peaks and signifying the end of this intermediate run. The intermediate line's back above market sentiment. They're both rising in the upper reversal zone, so everything else is really good. We just needed to be more than just a one-day rally. You can see we've had one-day move, and then we just don't go anywhere. And then it's kind of more like a one-day move, and then we don't go anywhere. Then we kind of have a one-day move. I mean, there are 2, 3, but really the bulk of the gains are in one day. And here we go again. The bulk of the gains in one day, and now that we have another near-term decline. That's kind of been the pattern here, and until we break that pattern, we kind of have to follow the pattern. So We'll see if that ends up being the case this go around here. As you can, that if the again near-term line peaks from here, wouldn't be, especially as you see on the other charts, where it's not in the upper reversal, like the Nasdaq 100 for example. It's definitely not in the upper reversal zone. So if it peaks on the S&P, it's peaking here, it would definitely be a bearish peak on this. And the near-term intermediate line, is below market sentiment. It's falling below the 80th percentile, and the near-term line's below that. So I mean, that's not a good combination here for the Nasdaq 100. And you can see we've been pretty choppy. We've definitely been in convergence mode, at the say the least, as we've been getting closer and closer down towards the 30-day moving average here. If you look at the Dow Jones Industrial Average, you'll see that we've really been converging there too. We got the bull tag, the intermediate line dropped below market sentiment, dropped almost out of bullish territory. It's bounced. Same thing. The near-term line's up above 80. Not really a big move. Not a significant higher high. So if we were to drop here again, like the S&P, then that probably would constitute, like this one, where we did get above 80, got to 82, but would probably be a bearish peak, like we saw in the last one. So we need more follow through. It can't just be this 1-2 day move. We need more to continue this trend that we're on and maintain the strength of this bullish trend. Then finally, if you look at the Russell, which was down yesterday, was actually up today. But again, its near-term line got a lot lower than the others and has bounced back up now, but is not even close to being above the upper reversal zone. So kind of like the Nasdaq, this is, if it peaked from here, it actually wouldn't be a peak. It would still just be a bearish move, a bearish near-term move to the downside. So so far it's just a one-day rally, and there's some pretty good indications that's probably going to be it. But if we were to follow through, and that's kind of what I expect, but if we were to follow through tomorrow and Friday and finish the week strong into options expiration, then we can get this strong near-term peak up in the upper reversal zone and get above the intermediate line, like say on the Nasdaq, especially since it's below the 80th percentile. And now we can feel a lot better about, okay, we're still on this bullish trend. Who knows how long it's going to last. It's already longer than normal. So we're already past the mature stage. We are in, very, very mature, extremely mature stage, and that can last months. So we'll take what we can get, but we need bullish near-term peaks to maintain it, not these weak bearish peaks. They typically signal the end of it, right? And like I said, I don't think that's the end of it's what any of us are looking for. If you look at the weekly chart. Remember we talked about that close. It's still up above, slightly, but it's still up above the last week's close. It is still a lower high point. So again, when we're, there's different stages that you can go through for a transition. The first very weakest stage would be a higher close that also that has a lower high on that, because then you expect the next candle to be a lower close, and then that would be your transition candle, or it could just turn straight into a bearish candle. The size of the candle is small. That's kind of suggests another sign of weakness there. And then, like I said before, the long-term PPO is pretty darn high. That's a big gap to fill between the 10 and 40 week exponential moving averages there. So again, if we do start to be bearish, we can be pretty bearish, uncomfortably bearish. So we don't want that, right? We want to maintain the bullishness. And as you saw, like in 2017, we can maintain bullishness for a long time. So, you saw that in 21, right? This is the kind of move we want to see. This is the kind of move we want to see where it's very weak on the bearishness, right? Just a little red arrow here, a little red arrow there, but nothing that even approaches the 40-week exponential. Again, the likelihood of that happening because of how high we are in the PPO is small. And especially, again, considering we're not starting move, we're actually pretty mature in this golden cross that we've been in now, that pretty much started back at the beginning, right before the banking crisis there, at the beginning of 2023. Three green arrow chart, we are back to three green arrows. So we have three green arrows, or we did. Looks like we don't now. We had three green arrows in the S&P. The MACD is, you see how close that MACD is. It's pretty flat. Had 2 days in a row of it being pretty flat. But it's still negative. You can see minus 0.03. So there's still a red arrow there. That's why we don't have the three green arrows. Stochastics is still above the 80th percentile. So it's still, in fact, we're now almost 3 months of it being above the 80th percentile, which is, again, that's pretty crazy for that to happen. And we still have that low there. So, but, as the 3 month window moves forward, again, it's unlikely to be above the 80th percentile for 3 straight months. That's a very extended period of time. You can see none of the charts have 3 red arrows. The NASDAQ and the Russell have 2 red arrows, with the stochastics showing a green arrow on the Dow Jones Industrial Average. Breaking those lines apart, you can see the S&P is well above its 8-day moving average, though again, MACD is below its moving average. That's why we have the red arrow on the histogram still. So very, very little, very sideways momentum, but at least it's pointed upward. At least it's sideways above zero instead of, it's never sideways below zero. But it's sideways above zero, which means we're pointed upward. So that's a good sign. The diamond's also above its 8 and 17 day. The Q's above it, showing that convergence in the MACD down there. And then the Russell also showing the convergence sign with the MACD down there, with the MACD below falling and below its now falling moving average. Looking at some of these other oscillators, we'll start with the DMI first on the S&P. It's been so bullish. Yesterday getting back above 40, which again, it's so rare to be above 40. It's really kind of not common to be above 35 for very long. But it is above 35 and it got above 40, but now it's down. The negative indicator is just getting smaller bottoms, right? Even now it can't even get below 20 if this ends up being a bottom. Again, we need if we can get it back down towards 15, again, we can maintain this bullishness that we have. Of course, a lot depends on the Qs. And the Qs, the negative indicator, has finally broken 25 here. And the positive is now we're close to 40, right? So unlike the S&P, which we were above 40 yesterday, the Qs is really dropping pretty sharply. So its ADX is barely above 20 as we speak. Really losing the strength of its trend pretty rapidly there. The RSI and the CCI, you can see it's still very bullish on the S&P. But remember, it's the NASDAQ that's driving things, and it's below 60. It's not below 50 yet, and it's also below 100 over here. Again, not below zero. So it's weak. It's not bearish, but it's also not strongly bullish anymore either. And that's, we're starting to see that percolate into the rest of the S&P. The strength of the trend, we did get above 21 on the trend strength. It's still there. Very, very mature on the trend strength. The Qs is also mature, just not to the same extent, but it's still mature and still positive on the rate of change. We're still above the, we're kind of flirting with the green line, but we're not below the blue yet. So we haven't lost the trend yet, but that's something to keep an eye on the next couple of days as we finish up the week. And then finally, the Bollinger Bands. We are still in the upper quartile in the S&P, flirting with the top, upper Keltner channel. Still pretty strong bullish momentum, even if it's dropping just a little bit there. If you look at the Qs, again, which is kind of what we're seeing, we're not in the upper quartile anymore. The bandwidth's a lot lower, and we're nowhere near the upper. Now the bands are actually inside the Keltner channels, and so is the price. So very different scenario on the Qs. We've had red dots for a lot longer here on the Qs, whereas on the S&P, we haven't had any red dots. So very strong trend that's been maintaining, but you can see the weakening right now on the Qs. In fact, if you take a look at the S&P here, let's take a look at the S&P. We like to look at the Qs relative to IWM, and there's a good chart there. But another way to look at this is to look at SPY or the Qs. Let's look at the Qs relative to SPY, right? So again, this is kind of like the leadership of the market is in the Qs, because the top 12 companies that we look at here in the Qs that we look at, at least the top 12 that are inside XLK, XLY, and XLC, these 12 companies make up 50% of the Qs. There are only 12 companies out of 100 stocks, but it makes up 50% of the index. So when you're looking at that ratio of the Qs relative to SPY, we're looking at how pretty much the Magnificent Seven are doing. And you can see we have been weakening, and we're really floored. We're down today. It generally has a positive correlation, though it's weakening. If we break that 200-day moving average on this ratio, it'd be similar to what I've told you before about this ratio breaking its 200-day moving average. And more than likely, they would coincide with bearishness in the markets, because again, it's leader in a market cap weighted index. Leaders lead the way, up or down, and so that's kind of what we're seeing here. You can see the weakness is developing. We talked about the rotation, right? The rotation of the bigger names. The rotation is moving in the wrong direction for those bigger names. Whether it's XLK moving down, XLC and XLY in the lagging category. That's not the direction that we want to see those particular areas of the market moving, considering that they make up the leadership of the market. Let's take a look now at the intraday moves. When you look at the intraday moves here, again, no new high points, so we still have a falling green line on the Arun indicator. It's a very, very small. We're back below 5% as the low is going to start moving up here. It's going to move up to that level. The red line has gone up to 21. That means the low has moved from here to here tomorrow. And it's going to be there for another few days. And then again, like you see how like even though we're up at the top end, we're pretty close to dropping below the midpoint of the, like if we were to drop below the midpoint of the range, you see just how perilous that would be. Like it would definitely be a sign that things have changed. And again, we haven't done that except for this one measly day there. The Nasdaq's the same way, right? It had a couple of days getting below the midpoint and really dipping below 40, which is bearish territory, but this dipped its toe underneath there, bounced right back out. So okay, good, that's bullish. But you can see now, like the divergences we've been forming, we're down below the average. The average is falling. Like we are not trading at the upper end of the range, and you're gonna break below the lower half of the range, which would be right in this area, would be pretty bearish. So you can see when you get below the middle of the range and you stay down there, and you don't bounce right back up like these other instances, then again, that's the beginning of the consolidation. Doesn't mean we're starting a bearish trend, of course, but at least it's the beginning of a consolidation there. The volume and the range today was very, very light, very, very light, very small very small on the range. Brought it back down. It was below 90% or 0.9 for a good chunk of the day. It ramped back up here with a little small increase at the end, but the volume you can see is down again at the 52-week. The 20-day average of the volume is down to its 52-week lows. So very, very low, very small ranges. Again, when the range gets above 1%, that will also coincide with the consolidation, and the volume picking up would also coincide with that. So it's very low down there. And then you look at like the volatility index, the VIX, it was actually down today, even though the S&P was kind of flat and down a little. But we're below the 90th percentile percent mark easily. We're at below 14. The VVIX had been down, jumped up today, so that's a sign that we would expect that the VIX will jump up too, right? The VVIX is at levels where the VIX should be picking up, and it's not. Like the VIX is still down, but I've told you before that the VIX is setting the stage for a move. And here we are again flirting with the 50-day average value of the VIX. We've done this multiple times, and every other time this is about where it's bounced up. So like I said before at the very beginning, I expect that this will be a bearish near-term peak. And I expect that volatility will bounce off of these levels that we're forming right now into options expiration, and most likely coming out of it here. Again, I don't expect huge drops, right? But just an increase, just a consolidation of the market, which we just haven't had in the first quarter, which we seasonally do have. And that might be, we might have put it off for too long now, and it's going to catch up to us. All right, now let's take a look at what's driving this price action. So the dollar was down a little bit today, and gold rebounded. So gold had the one down day yesterday. It rebounded here today. Let's take a look at just the daily chart all by itself. Here we go. And you see gold rebounded. Commodities rebounded big time. Big move higher on commodities today. Remember, those are the two things we've been talking about. And not surprisingly, yields rallied with commodities moving up. That's the combination, right? So let's take a look at some of their charts. Let's start off with that commodity breakout move. Let's go right here. Let's start off with that commodity breakout move, and you can see that's a big breakout, right? It's getting above multiple highs. You still got the point of control here, but that's a big gap here in between the 50 and 200-day moving averages. 8 and 17 have crossed above. Looking at crude oil, which remember is the biggest component of that ETF, it had a pretty decent jump up off of the moving averages. Still bullish. MACD and stochastics kind of flirting with their moving averages again. So it kind of needs to see more of a breakout. I mean, if it were to get above 80, kind of get up to like 82, then crude oil is going to be a trending move, right? I mean, it's trending now, but very weak trend. Not very strong at all. Like if you look at the trend strength indicators down here for crude oil, it's in a, it's a little bit lighter than an intermediate trend strength. It is bullish though, it's just not quite there. But if it were to take off, then it can really get going. And that's kind of what you're seeing now with commodities in general, filling in this gap. Now you have a weak trend developing there. So things are starting to pick up there. And of course, a bullish trend in commodities generally correlates to a bullish trend in yields, right? And yields have already been kind of trending higher, as we saw yesterday on the CPI, and then continued that move today, up right back up to these moving averages, back above the 17-day, kind of around this 200-day, but that MACD and stochastics are turning up. And again, if we get another, if we come off of a higher low point here, the expectation would be that we'd move up to a higher high point. And again, that's been, that's even last summer when we went from the end of July here to the, to Halloween, it was a move higher in yields that sparked that. We were okay at the very beginning, but once it really got going, that put a lot of pressure on equities with the increase in commodities as well, right? When you see the crude oil here, also over the end of the summer going into the Halloween move, was up above its 200-day moving average, above these averages. So again, that's a combination along with the dollar that has not been positive for equities. And so far, the dollar didn't really, let's see if I can get, there we go, didn't really go up today, but it also still hasn't gone down. Like we had that kind of 2-day breakdown out of nowhere, kind of a weird move. But then we didn't go anywhere after that. Like it hit the 62% retracement level and stopped. It's below the 50-day average, and you're still below the 8 and 17 for that matter. But you can see the histogram's rising, so it doesn't look like we're continuing the bearishness, and we're starting to kind of base and consolidate around kind of like an inverse head and shoulders type low point here on the dollar. So that can definitely have an impact. If you take a look, oh, it's snowing outside. If you take a look at our breadth today, remember the Qs were down, so breadth was actually pretty decent, right? We actually had a pretty good move. And when you look at that, the number of stocks above the 50-day moving average, the skew is still down, but the number of stocks above the 50-day moving average was actually well above 400 today. So it actually dropped back down to 395 here. You can see at the high we're at 412. You can see that on the little box down there. So we were at 412 at one point. We finished down to 395. The number of stocks above their 200-day moving average, you can also see, is still above 400. So we still, it's still at this extreme level. And again, the moving average is rising on both of those. So you still have, you have new highs and new lows. They're back up above their moving average. Not back up to new highs, but at least back above the moving average. So decent breadth on a day where the Qs were just really poor performer. It was a poor performer. The rest of the market was able to do okay, and you saw that. You see that in the rotation. The rotation, as I mentioned before, XLK, XLC is moving down to the left. XLK is in the improving category, but losing momentum now. XLU and XLRE, the interest rate sensitive areas, they're doing better, interestingly enough, with yields moving higher. Usually yields moving down is what prompts these to move up. Yields moving up put a lot of pressure on utilities and real estate. So they're leading in an environment where yields are starting to rise, and then materials and energy are doing okay because of that weakness in the dollar. But again, that's basing. So you wouldn't expect these four that are leading now to lead for very much longer. Staples is moving up. Healthcare is down at the bottom left. Again, that's kind of a hot sector along with the AI. You have the weight loss drugs. I mean, all of these sectors are really kind of moving on the daily chart over into the lagging or softening up and the weakening. Over here, you can see, remember, materials and energy and real estate and utilities are all in the leading category in the daily chart. They're really established down here in the lagging category on the weekly chart. So, any kind of strength that they're getting now is very, very much in the infant stages. And any kind of weakness we're getting in XLC and XLK is also very, very much in the XLY has been weak for a while here. But those two are just, XLC is still the only sector that's still in the leading category. You can see staples and healthcare are in the improving category. Those are your kind of generally safe haven trades. So in other words, we're like, what was our leadership, XLK, XLY, XLK and XLC especially, what was our leadership is now not our leadership anymore. And now we're kind of, the cyclical areas are really moving down, and our safety areas are moving up into the improving and leading areas. Even utilities and real estate, especially if they're able to maintain outperformance, because that's what this is all about. If they're able to maintain outperformance in a rising yield environment, that will just be, again, a sign of just how weak we are. Energy during 2023. If I were to go out a few years, so you can see 2023 or 2022 when we were really weak here. For most of this time, energy was the big winner, right? When we really started to go down and continue to go down, energy just stayed over here this entire time. So even though we were weak, utilities, staples, healthcare, those are all, but materials and energy. Even with the strength in the dollar, we're able to outperform because the cyclical areas were just struggling during that weakness. And again, you would expect that to be the case again. That energy would be your strength here at some point in time. And again, like I said, we're already seeing that on the daily chart, right? Where energy is right up there along with materials, and then these two interest rate sensitive areas, but also safety areas. All right, that brings us to our trade idea of the day. Let's take a look at Delta Airlines. You can see a nice little breakout move today. Has been kind of trying a lot 3 days in a row where we or 3 out of 4, where we started down, rallied throughout the day, finished near the same level before today finally just breaking out. Right, no gap down, it just broke out today to the upside and finished to a little off the highs. At one point in time, near the highs, we had a cluster today, which is actually a pretty good sign. But regardless, your near-term line is making a move back into the upper reversal zone. So we do have a good opportunity for a pretty decent bullish move. You can see on the weekly chart for Delta, we've already been on a good bullish trend, but this now we got a higher high, much higher high, higher close. PPO is rising. It's not really at extreme levels, so there's more opportunity for upside. Obviously, we've had 3 green arrows today. Now you can see the bigger move, with above average volume today, no less. The last 2 days, really pushing us through that important level. It also pushed us out of the value area, so you can see it really took off, and now we're above the value area. So there is some volume up here towards 48. But we can really kind of get moving on this. If you look at some of the other oscillators, they're all kind of right around bullish levels, above 60, above 200 on the CCI down there. The DMI for Delta is above 30, below 20 on the negative. So those are all really positive moves. If you look at the trend strength indicators, we're flirting with being in a mature trend. Or we already have been in a trend. Now we're flirting on getting into mature levels, which it can really get going when you get to that point. You're above, the rate of change is strongly positive. You're well above the cloud. Looking at the Bollinger Bands and the Keltner channels, you actually close outside of them both today, outside the upper band here and outside the upper Keltner channel. The band's really low, so this could be a squeeze type move. The bandwidth is low. It's inside the Keltner channels, so this is a move that we can really squeeze out and start to push it out a little bit and get these lines moving up. And so I decided to be a little aggressive on the trade for this. So I came out to April, but I went out to the really low delta at the 49 strike. Remember, the volume is right around 48, so right around that 49 strike, 48 strikes. So I kept my risk really small, giving me about a 3-to-1 reward to risk ratio, and anticipating some weakness, some kind of post breakout return move type weakness in there. So we got a little bit of wiggle room for that maximum gain to still stay inside the 1 standard deviation move, despite any kind of little weakness we had here since we got into it in the Market Outlook live video. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at MarketScholars.com for free. Follow me and like me on Twitter and Facebook as well. Have a great rest of your Thursday or Wednesday night, everybody, and we'll see you all next time.